Hey, this is Neil Bawa, the mad scientist of multifamily, and you're listening to the Mailbox Money Show with Bronson Hill.
All right, so on this episode of the Mailbox Money Show, I've got an amazing guest. I've got Drew Breneman. This guy has a really unique story. He bought his first duplex at 19 years old, which is super impressive. And we get into his story a bit. And the thing that I really like is he has over 15 years of experience operating large multifamily deals. He found one or two investors, large investors, and was able to just really go and do amazing stuff. So he's kind of a rock star even from a young age. Has a lot of insight into real estate operations, both on the multifamily as well as the retail and other sides and commercial side. And then also just, where's the Fed going? What's happening? What are some things, some opportunities he's seeing now within real estate? So if you own real estate, you're interested in owning real estate, multifamily, other things, he's got some really compelling stuff to talk about. So let's jump in. Really excited to get in this episode of the Mailbox Money Show. Awesome. So excited to have Drew Breneman today. How you doing, Drew?
Great. How about you, Bronson?
I'm well, man. It's good to connect with you. We have some similar stories of multifamily successes. You did it at a very young age, which I love to hear how somebody does that. Being as young as you were, being a teenager, basically getting started. So I think that's super impressive. But why don't you give our listeners just a bit of background on kind of how you got started investing and how you got this business scaled up to 200 million in multifamily. That's really, really impressive.
Yeah, I mean, and what's funny is my start is in a way so similar to yours. It's just somehow it just all happened to me when I was in a lot of it in high school. So I started this internet business where I was reselling items in these video games. This would have been back in like 2002. So Diablo 2, EverQuest, World of Warcraft were the names of the video games for anybody in their late 30s that might be listening and had played them. But basically, all I was doing was just reselling items that are within the game. So people would be quitting the game, and then I'd buy their whole account, their whole character in bulk, and then I just sell the items off one by one. This being like swords, shields, bow and arrows, items in the game.
So like in
And
like World of Warcraft, or you'd be like in the game selling like a digital item, basically. You'd sell it
yeah,
off.
yeah.
Okay.
In World of Warcraft, actually, I only sold gold. So it would just be I would buy gold from people who are quitting and then put it up on eBay or my own website and just resell it. Um,
Wow.
and so that's it. And so I started making good money doing that, where over the course of like a 4-year period, I made just under $100,000. And
And how old
I,
were you?
I, I mean, I started it when I was like 15 or 16. So,
Did your parents say like, "What is this kid doing?" Like,
yeah, I
not
was
really sure.
always really entrepreneurial. So they, before that I was a magician and then, tried doing other stuff, but this was one that really worked out. So I don't know. At that point, they were just kind of used to seeing me do it. But then also, they're both teachers, so they were supportive, but also they didn't want me to like drop out of school or like not go to college,
You're
and
making more money than they are, right? So they're probably like,
so
our kid's 15, 16. He's making more money than we are as teachers, probably, or close to it.
I never thought about that. I think they were making, it was might have been close, but that was over a 4-year period, so
Okay,
if it
okay,
was all in
right.
a year, yeah, I definitely would have beat them both probably combined. But they were yeah, so no, they were really supportive, and then they taught me some good habits where we weren't like a business family or anything, but my dad in particular always talked about investing in mutual funds and just sort of saving and paying yourself first. Some of these kind of, and that's paying yourself first means like invest your money before you start spending it on other junk, we'll say, or liabilities. And so I was hearing that kind of stuff as a teenager. Even though I didn't have anyone, when people ask like, "Hey, how did you get this idea?" or "Was this kind of what your family was like?" No, I was just the only one like this. No one, and that in a way made it more interesting for me. Um, Doing it as like a trailblazer, where it wasn't like I was in my grandpa's shadow who had this huge business or something. But no, so just I started just looking into what I should do with the money. And so I read all the, investing books that people read when they could just get started. I read Rich Dad Poor Dad, Intelligent Investor, Think and Grow Rich. I invested in the stock market and mutual funds just when I was in high school. And then I really liked what I was reading in a real estate book. It was called Investing in Real Estate by Gary Eldred. And that's still a book that I recommend to people now. Like if anyone's like at step one of being a active investor, like I'd get that book. It's really simple, and as whatever I would have been, 17, 18-year-old at that time, I understood what they were talking about and I liked it. I liked how it kind of combined like a business and an investment.
Sure.
It had cash flow. You pay the loan down. You had tax breaks. I mean, it had a lot of things you weren't hearing about with like the alternatives with the stock market. So I'm from the Milwaukee area and I went to college at UW-Madison. And so when I went to school there, I decided, okay, I'm going to switch my major to real estate. So I have an undergrad degree in real estate. And then my freshman year, I'll buy a duplex and then I'll move into it my sophomore year and then just kind of see what happens from there. And so I did that. I bought a duplex my freshman year. I moved into the first floor and rented out the other 2 bedrooms in there and then rented out the
from money
upstairs.
that you created in your business and in your life, you just
Yeah.
basically you moved in. And how did you qualify for the loan at that age? Do you have a co-signer or do you just kind of?
I had income actually on my tax return from the business. So
Okay.
I was able to qualify just with a normal, full doc loan.
Okay.
I think for the first one, I was able to, it's like I could have got like a 6% rate or something like this, or if my parents co-signed, I could get a 5.25. So they did co-sign on that one just to get a lower rate, but it wasn't, I wasn't doing any of those no doc because also this was
Right.
I bought this first one in 2005. So I could have, if I wanted, probably just done a loan saying I made a certain amount, but the rates on those were a lot higher. It was like 7 or
Sure.
8%. And
Okay.
so, one of the things I wanted to do from the get-go was find a deal that was cash flow positive. And so, I mean, part of that is not just paying anything for your interest rate. So then, just that was kind of my fallback plan, like find something that's cash flow positive. And then
Yeah.
and I'm in Wisconsin. I just thought about you in California. Maybe this isn't a fallback plan if you're in
Well, no,
SoCal, but for
it depends. It depends where you are. Obviously, this is something you're able to get into. You got a lot to your story, so I want to make sure we get into it, and we're just kind of moving a little slower than we need to move just to kind of get to where we need to get. You have 200 million now in multifamily. So how do you get from one house or duplex to 200 million? Like, how did that happen? How many years did that take? Are you raising the money for this? Like, how did you finance it? Maybe just give us a little bit of the high level of that.
yeah, it took me about 15 years. And really how it all started, I bought those first 4 deals myself. And then I found a partner, someone I was working with. He said, let's go talk to my dad. Maybe he'd want to invest. He did want to invest. And then the 3 of us, we bought over the next 10 years, 100 million of property.
Wow.
And then I was planning my whole career just working with those 2 guys. And then actually in 2019, the son in that relationship, he passed away just unexpectedly. And so I started to sort of, knew, okay, well, I'm not going to be growing as much now without the younger partner. I just have the dad in the deals. And so I found I had another relationship kind of similar to that had not really um, kind of explored much. Another person I met at a property of mine who also had a family member who could invest. And then kind of the same thing, just rinse, repeat, same sort of business plan I had with the first family I did with the second one. We bought another $100 million of property, me and this other family. And then the rest I've just syndicated, just kind of traditional pass the
Yeah.
hat type stuff.
That's really interesting. We've raised about 35 million for different deals, both in multifamily and other projects, and it's here's stories about this. Oh, I had one person that invested, which it's a great benefit because you just have one call, one person calling you, you're having call, a little bit. We'll have 120, maybe 150 investors total, so we get a lot of people reaching out, all kinds of different things. But I guess the downside of it is if something happens with that investor, then you've got to reinvent, you got to recreate yourself. But it sounds like you've been able to do that. You've been very successful at doing that. And so, okay, so that's the money side, and you're operating these yourself, Breneman. You're the asset manager, and then you have a
Yeah.
property manager that helps. Okay, so
Yeah, I haven't done any co-GP deals or anything. This has been, really I had a partner too, in the main business on each of those. But yeah, so we do every aspect, find the deal, run it, raise the money, sign on the loan.
yeah, that's amazing. What do you see? I want to talk a bit. First of all, well done on all that. You've been in areas like Phoenix, Dallas, and Austin, and some great areas. What are some things that you're seeing in multifamily right now? I think a lot of people are either in multifamily, they're kind of scared because some investments now have had capital calls, or they've made it pretty tough. I mean, have you seen any of that, or what are you seeing right now? Obviously, lending has changed. Are you seeing, you also syndicate as well? have you seen appetite soften for deals? Have you seen performance suffer in areas? Are you guys doing all long-term fixed debt? Like, what are some stuff that are you engaging with the market right now?
So I guess high level, all of our deals are fixed rate except for one. We did just a debt fund floating rate deal. And that's really on our portfolio the only one we'll have to like think about and potentially add money to, or do something with. And where the other ones are just they're all cash flow positive. There's nothing to think about, where even if they were in like areas that have pulled back, like a Phoenix or something, I mean, they'll still stabilized at above a 5 cap when we borrowed fixed rate in the 3s. But most of my deals were in the Midwest. And then the expanding to the Sun Belt's been more recent in the last 2 or 3 years. So then what I've noticed kind of comparing the Sun Belt and the Midwest, today, is there's really not any notable distress in the Midwest in terms of like just a typical, what you think of as distress. People were way more conservative there because it wasn't having the crazy rent growth the Sun Belt was having. So, the deals there's not like any thought like, oh, there's going to be a lot better deals coming in a year or two in the Midwest. And those deals today look pretty good. Chicago, Indianapolis, Grand Rapids, those are some of the best markets the last, year and a half, 2 years now, for rent growth in the country and for occupancy growth. So those are just holding up fine. Where I think the Sun Belt, what I can see happening is, in about a year, then finally like the 3-year floating rate loans people took on in 2021, like those are going to start coming due. And then there's going to start to be, better deals from the buyer side. So, and then if you're an investor in those deals, I mean, I don't know how, it'll depend how good of information you're getting from the GP you invested with, if you're going to be able to make a clear decision on if it's worth making the capital call or not. Like it's some of these deals with what I saw some people pay, I don't know how they ever get out of them, truthfully.
Right. Yeah. And that's the challenge. Some people, they paid, too much, or they were too ambitious. And if they had any sort of setback, which usually you do, I mean, you're doing a value add deal. Usually there are things that don't go according to plan, where renovations go slower, your occupancy dips, something happens. Rarely, I guess it goes that, that doesn't happen if you just got a, best in class operator, but that stuff happens. Then a lot of people are finding that now the value, and they're trying to refinance, is not even what they paid for the place. So that's obviously an issue, and you have all this investor equity that's involved. So it's just interesting to see. So that's good. Well, you have a lot of fixed debt, which is really good. What are some challenges that you found, or things that you've learned over the years about operations? Obviously, when you're managing single or small multifamily, it's very different than managing, a large, you have some deals, up to a $50 million deal size. Like when you're managing 100 or hundreds of units, like what are some things that you found to be best practices, Drew, as you're doing that?
Well, yeah, I guess one insight for multifamily, this is, applicable for anybody investing, whether it's a GP or LP, the real, CapEx number on a property, it's not the $250 a unit a year that a lot of people or lenders would underwrite. I mean, it's closer to $1,000 a unit a year. Depends on the type of property. So let's say on a lot of the stuff we have in Chicago, it's larger units, it's newer, nicer. So you'd think there wouldn't be much CapEx on that. And the real number, how those run, it's like $1,000 a unit a year. On more traditional, kind of like a garden style deal, which isn't as nice, it's less than that, but it's still way more than the $250 a unit a year. It could be $600-700 dollars a unit a year. So I think that's one thing that when the more you do this, you see that. And that's too, when I've saw another a guy who's involved with Northland company, has billions of dollars of apartments, and he said he thought the real number was like $2,000 a unit a year.
Yeah. Wow.
But they have more like institutional trophy type stuff. So that was the first thing that came in my head in terms of like, so that's like on the number side. And then I guess really the main thing that I've learned is you just get a lot better over time, getting experience like within a given market. So if it's your first deal, like at all investing, it's going to be tougher than your second one. And it's the same thing when you move into a new market. So this is, something that I think about where you kind of got, like we bought our first deals in Phoenix just 2 years ago. And then now how much tighter our underwriting is, and having real expense comps, real rent comps, because we have our own buildings there. We know what property manager we'd want to use for a certain type of building, and one we'd want to use for a different type, and who we'd hire for the renovation. So I guess, operationally things they can start slowly, but then especially once you're in a market for a while, you kind of start to compound your successes, if you will, when knowing who to use, what to do for given business plans or situations.
Yeah, yeah, and I imagine that, the more time you spend doing something, the better you get at it. You've had, been able to accumulate all this experience from a pretty young age, and you started pretty young, and then found some partners, and which is awesome. There's some people that I've seen that are younger, been able to get a lot of great experience and be able to really leverage that into operating. And so, what would you say for someone who is a investor? A lot of people have said, "Oh, multifamily is not going well right now," or maybe their deals aren't going well. But it sounds like you're finding markets where deals are going well. And so, what are some things that you look for specifically for in particular markets, or from an operating team, or things that I guess are special considerations today, considering higher rates, considering underwriting, considerations and things like that?
I would think about minimizing variables. So like a lot of the deals, I would assume where you're saying they're running into trouble, they were renovating the property. They're doing a floating rate bridge loan that has a 3-year term. There's a lot that needs to go right for that deal to go as underwritten. So they need to execute the renovations. They need to be able to execute a refinance or an opportunistic sale. So I think what I normally think about, but it's just way more obvious now, is just minimizing variables. So compare that with buying a newer property where your business plan is just the rents should be $1,400, but they're only charging $1,200, and we can go in with a fixed rate loan right away at reasonable leverage. Today, like most of the deals we see, they don't size out for very high loans, so it's hard to hit decent returns. But most of the stuff we see, it's 55 to 65% leverage. But because of that, so you're going to have to take somewhat slightly lower returns, but I would think more about minimizing variables, where you're not going to get burned on a deal if your business plan was it's a 2-year-old property, the rents are below market, and we're going to own it for 10 years. Like that's maybe you're not going to probably make a 20 IRR like the projected renovation deal would have. But if you are kind of trying to find out what should I be doing today, and you're worried about being in another deal with a capital call, that's what I'd be thinking about.
Yeah, no, that's really huge. I think that's a really great advice. I've come to see that the value of that as well. We've done a lot of more heavy value add stuff, Sunbelt, bridge debt type of stuff, and just seeing the value of having deals that are fixed debt, longer term, less leverage, and they're not as sexy. Sometimes there's loan assumptions, other things like that, where it's like you're putting 50% down, and maybe instead of a 18% projected return, you're at a 12% or something. But it feels safer. It's a different type of investment, different profile. And I've seen some investors do incredibly well over the long term by doing that. What would you say, as an investor, you've had, there's a lot of growth that's happened, a lot of things we haven't really talked about in there. Obviously, you were very hungry and very interested, and you were very curious, and you did a lot. But what's something, if somebody is a passive investor or interested in being active, what are things that they can do to grow, like to learn more, to grow? You recommended a book. Are there other sorts of events or things that you'd recommend that people, get involved with to try to learn more, to grow as an investor?
Well, I think going to anywhere where you can be around other people doing it. So whether that's a meetup or a real estate conference or some of these mentorship clubs, like that all makes a lot of sense to me. I learned a lot myself just asking questions of other sponsors. And I had a lot of the friends, since I majored in real estate, where I could ask, what are you doing at your company? Or where I could go up to people who were older that also went to UW Madison easily and ask, how did you set up your company? Or what is your strategy today? So, I mean, asking questions, and whatever that, direction you want to take with that, whether that's going to be people that were alumni from the same college, or could be more like a meetup type thing. I mean, that's what I'd recommend.
Yeah, we talk about that a lot. We talk about the two things that really help you grow as an investor, whether active or passive, or networking and education. If you can get in the room with amazing people, it will definitely help you to grow. You'll learn a lot, especially from stories or things that haven't gone well for people. If you can gather from those, it's huge. And then also just there's the networking, the education components of both of those are big. Yeah, I guess that's how somebody would grow. Are you involved in any other assets, or is it 100% multifamily? Is it pretty much?
Well, I used to do other product types too. I started out with that first family that I partnered with. We were doing mostly commercial at the start, retail, office, industrial. But we just realized over time that multifamily had the best risk reward profile. I went back and calculated some NACREIF data from 1990 to 2020, I believe, was the time cutoff, and multifamily had the highest returns and the least return volatility, so the lowest risk out of all the major product types. And so we just we didn't realize it, but it was starting in 2013. We basically were just only specializing in multifamily because if it probably since 2013, I probably did 25 deals and just 3 of them were not multifamily, but it wasn't really a strategy or something I was, I would say announcing until 2021 when we just only do multifamily. So I can talk about other product types if you'd like or
Sure.
anything, but
yeah. No, I think we see sometimes in recessions that we think we're already in a recession, but it's not official. It's just all the characteristics of recession are there. But self-storage has been one that some people really like, or mobile home parks. And it sounds like you've done some other retail and other things as well. Are there other assets, I guess, that you find from a relative valuation? I think it's good to look at, okay, hey, right now, like I think anything from 2013, 2014 up to like 2020 for multifamily was just, you could do anything, and it was like everything worked out pretty well because of lower cap rates, because of demand. There's a lot of things that were kind of going rent growth and things like that. But right now, there are things that are maybe, attractive as well besides multifamily. What are some areas that you find, or assets that you find within real estate, or other areas that you find interesting now?
well, I still think that multifamily provides the best, has the most, the best debt options, the best tailwinds, demographically, it has such a diversified like income stream. So I still think multifamily is the darling of the real estate world. But if I had to pick, what do I think is the next best product type, I'd actually would say retail properties. And I know that would be a surprise because retail's not, you think of malls and some of these big box centers, those are almost like a swear word with lenders or investors. But I still own a few small shop retail deals, and I have almost never lost a tenant in those, where it's a business where if they're doing well, it's not like an office building or industrial, they need to expand and they're going to leave you. They're going to open up another location somewhere else, and then they don't want to leave from so you can end up with stickier tenants than people realize in retail. And I'm talking, I guess, about small shop retail. So like the outlot building on the corner that has, a Panera Bread, a Panda Express, Verizon Wireless, like those kind of tenants. And those are the types of businesses we have in those deals that I'm in. And so I think that, and then you don't have to worry about as much about the operating expenses then in terms of the growth, because these are all leases. So the tenants are reimbursing you for the operating expenses and the real estate taxes and the insurance. It still matters somewhat. It still matters because when you go re-rent the space or you have a lease renewal discussion, if your property taxes and other costs went through the roof, that they're going to be complaining about their gross rent, their total rent number, and why they need a reduction in rent or can't handle such a big increase. But I'd say retail is really interesting because you can have some, if you're thinking also about a recession, like a longer term leases. So maybe a nice tenant locked in for 7 or 10 years, where by then we'll be on the other side of whatever we're going into here. And then also it's not, industrial, multifamily, storage. A lot of this is priced for not priced for perfection exactly, but priced for like a lot of things going right, where retail, it's not, it's a little more under the radar. So you're going to see a higher cap rate than in storage, in industrial, and in multifamily. So that's also why I guess I picked that, is you're starting out at a higher yield.
Yeah, that's great. No, I think that's all. It's all important to look at, relative valuation, the advantages of the asset, and once you have some experience with it, it helps you to know, hey, I want to do more of this, or I don't want to do more of this. But I think, yeah, if you can find the right deal, and I think retail is a very interesting space that a lot of people don't do or kind of shy away from because you have a vacancy or different things. But if you find the right deal, it can make a lot of sense. Do you have any opinion on interest rates? You think they're going to come down soon? Do you think the Fed's going to hold them where they're at, or go higher, or what do you think? It's going to like in 12 months or 24 months?
Well, I think it's hard to predict the Fed, I guess, where I mean, they are, done with their rate hikes or one or two hikes away. I mean, but that really doesn't drive, I mean, like a lot of the real estate borrowing, unless it's the debt fund borrowing, where all the debt funds were SOFR plus a spread, which is like correlated almost 1-to-1 with the Fed funds rate. But all the other loans and all the ones we do, like a 5-year Fannie loan, those are all priced off of the 5-year Treasury. And that's, whether that goes up or down will have a lot to do with the economy. And so I think if someone thinks recession, then rates are going to drop. So I think, my personal thought is I think we've been in this band with, treasuries normally being like 1% and now we're up to 4% on the 5-year Treasury. So, I mean, I can see rates pulling back, where treasuries are back into the twos. It's hard to say an exact date, but on all of our deals, we're doing 5-year fixed. I guess this will be the way I think of it. And when I think what rate will I be refinancing into, I think it'll be around a 5% interest rate, I guess, to put it, and how I've been thinking about it, where I don't think we're going back into the threes for first mortgages, but also I don't think we're going to be in the sixes here forever. I feel like it took a lot of effort to get rates as high as they are. And so even though rates used to be, a lot higher, I mean, they were 18% when my parents bought their first house. So, I know that, but the economy was a lot different then. The GDP growth of America was huge. I mean, we were a huge growth engine for the whole world at that point, and we're growing a much slower now. It's a totally different animal. Right. So
yeah. Well, Drew, I appreciate you, man. I appreciate congrats on all your success, all the things you've done, and you've really developed some great investments. I mean, and really also some great partnerships. You've had a couple large partners that you've worked with, and you've obviously learned a lot about this. Been doing it for years, so I just want to commend all your experience that you have. If people want to connect with you, how can they reach out to you?
Yeah, so I'm on social media, just I think every platform at Drew Breneman. So you can go there, or our company's website, Breneman Capital, and that's breneman.com. And then lastly, I have my own podcast, the Breneman Blueprint. So that's a real estate investing podcast. Get into both active investor and passive investor content, like LP, GP red flags, or something to look for in a sponsor. So trying to, help, spread some real estate education out there. So, thanks for having me on, Bronson. Really appreciate it.
Thanks, man. Appreciate it. I'm excited to be on your show as well. So thanks for being here, man.
Yeah, thank you.
All right. So Drew Breneman has a lot to say about a lot of things. And again, something when you talk to somebody who is a great operator, they typically talk with a great degree of comfort about their asset, right? They're able to say, hey, I like this for this reason. This is what we're doing. This is where we're at. And they're willing to share things that didn't go as well, or things that they would do differently, right? I think when you get to somebody, they don't have those stories, they're just not really being honest, or, they've been lucky. But I think when you, Warren Buffett has a saying, it's not until the tide goes out that you see has been swimming naked. So from what I can tell, Drew's done a great job as far as, really making sure that he is positioned correctly, having long-term fixed debt, going for stuff that's not as sexy as far as high returns, but stuff that's just been really steady Eddie. So in our investment club, we're doing some amazing cash flow investments outside of real estate as well. We have our multifamily, we've got our ATM fund, which is super consistent cash flow. So if you haven't heard about that, we usually offer that a few times a year. Love to fill you in and get you connected on that one. But anyway, I just appreciate you taking the time to educate yourself. It really does inspire me. This is why we do this, is for you. If you haven't left us a review or put a comment or smash the like button if you're on YouTube, would really appreciate if you do that. But thanks for taking the time to educate yourself. I look forward to seeing you on the next episode of the Mailbox Money Show.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.